protests continue to heat up in Hong Kong's airport, causing a second day of delays and cancellations. The Chinese government is now escalating its response from warnings to threatening military action against protesters and saying they are, quote, asking for self-destruction. It's a threat that China is not issuing lightly, as Chinese media released videos yesterday of military vehicles lining up at the border of the city in the mainland. Meanwhile, the yuan's midpoint was set to 7.032 per dollar on Tuesday, a decline from Monday in China's continued devaluation of its currency. Things are certainly heating up, guys, aren't they? I'm really intrigued by the level that this protest is escalating to.
Yeah, so, well, here we have a weaker yuan than what we were worried about last week, but obviously the market reaction last week was much worse than what we're seeing now, notwithstanding the tariff delay.
Well, now you see what has a stronger effect. A
right.
delay of extra tariffs on China is more powerful than the continued weakening yuan.
Yes, well, and the other thing to point out is that I think the market tends to have the biggest reaction when we first learn about something, and that as we get more used to it, the market kind of says, okay, we can deal with that. And I think you could argue that the yuan situation last week was an overreaction by the market. But yeah, certainly this tariff delay is sort of trumping everything else in the market right now.
No pun intended.
Yeah.
Let's stick with the U.S.-China trade conversation and that delay on the extra 10% in tariffs. Let's bring on Keith Lerner, CFA with SunTrust Advisory Services. He's joining us live from Atlanta. Keith, thanks for coming on.
Great to be here.
Let's talk a little bit about the markets right now. I mean, obviously, look at what is happening, up more than, looks like, 400 points. Yeah, 465 points. We had seen so much volatility in the last week or so. So you look at how the Dow is behaving today. What do you make of everything and the announcement of delaying that tariff until December?
Sure. Well, the first thing I will say, the activity, these swings we've been seeing in the market over the last week or so is very consistent of what happens after a shock period or a sharp sell-off in a short period of time. You have investors that are caught off guard. There's a battle between fear and greed. And those headlines that were behind the initial sell-off still linger. So this is really normal activity. One thing that I think is positive, and we wrote about this morning, is sentiment has become so pessimistic, meaning we've seen huge equity outflows. We've seen a lot of demand for downside protection in the options market. We've seen the percentage of investors that are bullish come down to the lowest level since late last year. And when you have such depressed expectations, much like today, a little bit of good news can go a long way. And I think that's really the story for today. People were just braced for everything being negative, and you have just a small piece of positive news, and there you go. You have a market that's rebounded pretty sharply today.
Hey, Keith, I wanted to ask you about the Hong Kong protests, because a lot of folks were saying that these protests were sort of the biggest risk for the market. But was that because of the trade situation with China? And now that we have, you could say, thawing trade tensions, should we no longer worry about the Hong Kong protests?
I think the Hong Kong protest is still a risk, and it's also a risk at a time when you have a lot of global uncertainties. However, coming into this year, our main investing theme was investing amid a carousel of concerns, and Hong Kong is the newest member to hop aboard this carousel of concerns. So I definitely think it's worth monitoring. It's a big financial hub, but it also suggests to us this is another reason why we continue to recommend or have a bias towards the U.S., which is less dependent on trade overall. So I think this does take into account how you should position portfolios, and it's something you should not dismiss.
Keith, let me ask you a little bit about all of the hand-wringing over the Fed, too, and what might happen next. I mean, for so long, we were saying that, wow, the market is just completely responding to Jay Powell's every word. We saw that when we finally got that recent cut announced, which everyone was anticipating, and the anticipation of that cut had sent markets higher. Then we got the cut, but then people didn't like what Jay Powell said after announcing the cut. So where do you think the Fed goes from here?
I think, our baseline view is the U.S. economy is on solid footing. However, the bond market is screaming that we need to have a Fed rate cut, the inversion of the curve. We believe there will be at least 50 basis points later this year. It may not be all at once, but the bond market is really screaming right now that they need to cut rates to try to uninvert this curve. And we think a lot of this inversion in the curve is related to this gravitational pull of lower yields overseas. But and we still have the trade uncertainty, even though we got a little positive news this morning. And when you go back to Chairman Powell's testimony, he did mention, the global tensions, the global turmoil as one reason to cut rates, and we think there's more to go on that side.
Keith, will the Fed cut rates in September now that we have this possible concession on trade? Because you had economists over the past couple of weeks come out and say the Fed should come out ahead of that September meeting with a rate cut. I mean, that's how dire people felt things were.
Yeah, we're in a very emotional period, and the Fed cut rates one day, and the next day people were asking for rate cuts. The next week. I'm sure if things become worse, they can go outside of schedule. But right now, it looks like more likely scenario is a September cut. We do think they will likely cut rates again, more likely because of the global uncertainty. The tariffs, we have had some of that tariff uncertainty lifted today, but it's not out there. And then when you look at these global bond yields with 15 trillion in negative yielding securities globally, I think that provides an impetus for them to go ahead and cut rates. And also, you don't want the U.S. dollar to become too strong, and if you keep rates higher, you'll probably see more strength in the U.S. dollar. So all in all, we think that's the more likely move. One important note about Fed rate cuts, we did a lot of work on this historically. And when the Fed cuts rates, historically, it's positive for the market as long as you don't go into recession, which makes sense. Given our base case is no recession, we still think the path of least resistance for the market over the next 12 months is higher. But we certainly anticipate more of these bouts of downside volatility like we've seen the last week or two.
All right, that's Keith Lerner of SunTrust. Keith, thanks for coming on.
Great, thanks for having me.